the Fed put's truly gone. They're truly going to get inflation back to 2%. How bad does it get? Numbers get to a true, say, 2%, and you actually get that lag effect, and you could have a negative print CPI. And what the Fed does there, really unclear, because it's not accurately reflecting what's going on in the economy, right? How well does it work, right? And this was shocking to me. If you look at Case Shiller or any other housing index and graph it to OER, you'll see that owner's equivalent rent is sticky. It ranges between 0 and 5. Even during the financial crisis, we knew homes went down significantly. It barely dipped negative and only briefly.
Caleb, thanks for joining us.
Yeah, thanks for having me on. I appreciate it.
And so what did you find out?
Yeah, so you hear on TV, you've heard Ackman talk about it, Larry Summers talks about it, this thing called rent of shelter and CPI, and that's essentially the housing component. And last year it was around 32% of CPI. They adjust it based on different surveys, things like that. This year they adjusted that to be 34% of CPI. So it's gone up in weighting as well, like substantially if you think about it. I know 2%, but it does matter. And that was sticky. We kept seeing Case Shiller peak in June of last year, and it's been down. It's down a little over 5% since June of last year. And the CPI month over month has entirely been driven by this shelter thing. So I'm sitting there like, this is odd that you're seeing, Zillow rentals, Case Shiller, any other sort of housing indice show a drop, yet CPI is still showing an increase. And if you actually look at CPI x shelter, so if you look at all of CPI and you take out that shelter component, we actually peaked or are relatively flat from June of last year, right? So what the Fed has done is effectively working. It's just not showing up in the data, and that's because of the shelter thing. And I guess what you're probably wondering is, what is this shelter component? Well, there's two major components of it. One is rent of primary residence, and two is something called owner's equivalent rent. OER is kind of what I'll reference that as. OER is the tricky one. The rent one is pretty simplistic, right? They survey a bunch of people. What are you paying for your rent? They do it every 6 months. The OER calculation is pretty complicated, and there's lots of papers. Cleveland Fed has done papers on what this is. So I spent many hours sort of trying, one, to understand it, two, best ways to predict it, because the entire market, trillions of dollars are at risk, and I'm specifically in the rate side. How do we predict this number, and then how do we use that, and how will the Fed use that going forward? And as I was digging deeper and deeper, first off, I realized to get this number, it is a generic survey. There's 32 houses, and I think there's 125-ish million, 123 million households in the U.S. They use 32,000 for their sample size, which is fine. I mean, there's definitely some sampling error that goes in there, but it's not astronomical. One surprise that first came out to me is only 62% of people actually respond. So they do what's called imputation on the rest of that, which if you look at the employment survey, they actually collect 98% of surveys. So there's a big miss in these two. The other thing is it's a little bit hocus pocus in the way they do it, in that, they ask you very simple questions, and it does not include home prices at all. The question basically is, what could you rent your house for if you own a home, if you were to list it today? So one, there's a lot of inherent bias in that. It is your home. You may be higher, you may be lower. There's definitely a media effect involved in it. And because they only do this survey every 6 months, it can get relatively stale quickly, and that's where the imputation comes in. They do quality adjustments. They actually do a depreciation adjustment. There's tons of other things. Like, the amount of adjustments they do on this is shocking too, and you could see that in the data. I actually have some charts I can go through if you guys want me to pull those up, just to give you, we can start with what CPI is first, like what the numbers are. And I'll just do this from the beginning. So first off, we all know these headline numbers peaked. I want to say, I can find the exact number. It looks like middle of 2022, kind of in line with where Case Shiller peaked. Some of the other numbers here's just a chart of it. You can see how stable it was over time before skyrocketing during the pandemic. There's supply chain issues, housing went crazy, The Fed obviously bought a lot of assets, etc. This chart is interesting because it gives you all items less shelter. And a lot of people don't dig down too deep. They just look at that top number. That's all items. It's year over year CPI changes. And most people reference that and the core. So all items less food and energy. And that's the second one that's highlighted in yellow there. They also break down a nice little thing, all items less shelter. And you can see that year over year number is 3.4%. You can kind of see where it's trended. Okay, it seems like, inflation's sticky, just as the Fed's saying. It's pretty easy to see that if you just look at a first line when you're looking at it, if you don't derive the second level of what's actually going on in the hood. I just want to highlight that shelter, like I said earlier, is 34.5%. If you break down what actually is under shelter, 25% of it is this OER number, which is wild to me that wages and things like that are driven from a survey that has a ton of adjustments, things like that. Actual rent of primary shelter is only a little over 7%. This is back to, let's see. So what exactly is this OER? I think it's important to truly understand what goes into it. And I kind of touched base on it a little bit earlier, but if you look here in how many they collected, I gave you these numbers earlier. The BLS actually at the end of this has a really good thing, but this is the chart I really wanted to pull up. How well does it work, right? And this was shocking to me. If you look at Case Shiller or any other housing index and graph it to OER, you'll see that owner's equivalent rent is sticky. It ranges between 0 and 5. Even during the financial crisis, we knew homes went down significantly. It barely dipped negative and only briefly. And again, it's survey related. You don't want to say your house going down in price. A lot of times you want to say your rent's going up. There's all different kinds of biases in this. And the Cleveland Fed actually did a really good piece on how do you predict this. And they found the most predictive nature of OER was momentum in OER. So you can take interest rates, you can take rental rates, you can take, they used a variety of factors. It's a pretty in-depth paper they did. And it's just momentum. And that to me is sort of media effect. There's definitely a lag in it element, but I found it incredibly interesting that momentum was driving it so dramatically. And it could be data collection. There's a variety of reasons why, but it was by far and away the best predictive variable. And I just wanted to highlight, if you look at other sort of like what rents have done, for example, rents peaked in September of 1997. Now they're actually down 0.05%, not showing up in CPI. I'm pointing out June because I want to get to something I think is going to occur in all these, but in June it was 1956. So it's only slightly up since then. And if you look at home prices, they peaked in July, but June and July, there's a very little difference. According to Zillow, they're down 3.18%. If you look at Case Shiller, they're down 5.06%, so 5.1%. And yet we had not this last month, but the month before, the largest adjustment in CPI month over month was 0.8%. There's been a couple months of 0.8% to CPI. And not this one, but the one before, if you stripped out that, you actually had negative inflation, right? It was all driven by this rent of shelter number. I have some links here at the end. I can send them to you guys later. You can post them in the comments if you want to. But that's kind of the gist of it. And so I guess one important thing, I'm going to go back to the screen because I want to show you one other thing in here that I think goes with my thesis on what's going to happen with inflation. This is important because if you look at CPI, and they use the NSA index in it, right? Non-seasonally adjusted, and that's the headline number we're seeing. Well, if you look at June to now, it's up, call it 5 points on a percentage basis. It's very minimal, but you got to remember, it's just basic math. It's coming from a baseline. So the baseline back in, say, January was 281. You kind of hit this 296 level, and it flatlined relatively, and it's recently gone up again. And the other interesting thing is if you look at all items less shelter, we actually peaked in June of 22, and we're actually down now. It's this number. I don't know if you can see my mouse, but this is 276, and we're at, 277.2, and we're at 276.6. And shelter continues to go up with this. So Essentially, if this lag effect, which is showing up in Case Shiller and in Zillow and any other housing survey you look at, X the CPI housing survey, realizes, and there's some lag effect, and I've read numerous research papers, and the guys I referenced earlier talked about this. There's a roughly 12 to 18 month lag in CPI to actual housing conditions. So if housing starts dropping, say today, it'll take 12 to 18 months typically for that to reflect in the data, in the CPI data. And there's numerous theories on why that is. You'd think it would be 6 months because that's how often they resurvey people. But that's essentially kind of what it comes out to. Well, if we peaked X shelter, right? If you look at this index in June, or yes, in June right here, if shelter in June starts to show that lag and turns negative, you easily could have a flat to even negative, because if shelter actually starts going negative in CPI, which is probably unrealistic if you look at owner's equivalent rent component of it, it's probably not going to go negative. But if it goes flat, you'd have to have pretty substantial increases even to get to 3-4% in the rest of CPI, right? Just because from our baseline at that time, just the basic math behind it, you really would need to see a substantial increase in all other goods. And we're already seeing, used car prices come under pressure. There are numerous other components of this that are trending down heavily. And if those numbers get to a true, say, 2%, and you actually get that lag effect, and you could have a negative print CPI. And what the Fed does there, really unclear, because it's not accurately reflecting what's going on in the economy, right?
So that one of the things that you pointed out was that the inflation rate actually is negative if you separate out the shelter component.
Yeah.
And which is why it's so important to start understanding at this moment what's going to drive that.
Yeah, I mean, we all know that rates act in a lagged manner, right? If you're getting paid on your cash 5%, you may not spend as much cash. You kind of like getting paid on that, right? And if real goods, I know the way CPI calculates real goods to be flat, but if you look at food, it's still very high. There are things that are hitting people's checkbooks. CPI is a very complicated thing, right? And it affects different populations in different ways. You look at, say, the wealthiest people in the country, their food prices going up doesn't really impact their day-to-day life. You look at the bottom 50%, it really does, right? And consumer spending is what, 70% of GDP. If there's a lag effect and people are into refi, different things going forward, whether they trade in their car or whatever they're doing, or even credit card rates, I think it's really going to hit at some point. And I don't know how the Fed's going to react. They're very adamant they want to stay higher for longer. The economy does seem to be kind of chugging along just fine. Look at all the most recent data, and so it's hard to know what they're going to do, because one, if they hold and CPI goes flat for, say, a couple months, because this number reverts so much, and then we go into a deep recession, it's going to be two policy mistakes from the Fed. And you got to remember, these are not unelected officials, right? You could see a lot of political pressure from both sides if people are really struggling. So do they want to make that mistake again? Would they cut? What are they going to do? And obviously, you can't afford a home right now. You look at home affordability, it went over pre the financial crisis levels, right? And so there's a lot of elements at play here that just take time to come into day-to-day life.
Obviously, as inflation went up, their sort of nuance and preference for core PCE disappeared, and they stopped really differentiating between different kinds of inflation, and they just had this monolithic concept of high inflation and we have to attack it. And all nuance and and specificity went out the window. And they haven't, and it seems like Chair Powell, I guess, he's had some commentary about, this kind of the specific aspects that you mentioned, Caleb, trying to strip out certain things and look at various parts, but he doesn't seem to be getting a lot of support from other members of the FOMC. I'd like to hear more about your thoughts on how the Fed has sort of been grappling with this and almost speaking out of two sides of their mouth when it comes to these various the quirks in the metrics.
Yeah, I mean, they put themselves in a hard place, right? I think people forget when inflation started going up, we were in a pandemic, one. Two, they were talking about lockdowns, right? People forget that. Imagine if the Fed started raising rates and tightening financial conditions as we're locking down. Like it would have been so unpolitical or so politically incorrect at the time that they would have come under stress for that, right? And so they were late to act. They know they were late to act. And then they put that in their rhetoric saying it was transitory. Well, define transitory, right? Clearly it wasn't transitory when all was said and done. There were supply chain issues. There were bigger things that were going on in the background that I think most people didn't realize, like how reliant on China we were, right? The zero COVID policy they had really hit our supply chains hard. And they didn't really have an opportunity to act until they did. Now, they could have done it a little sooner, but I mean, we forget how heated the COVID situation was at the time. And then I guess the big mistake I think they made is the pace of the hikes, right? These are unprecedented hikes. Like it's the fastest pace we've ever hiked. I think we've done 75 base points one or two times. I think I have to go look back in history, and we didn't just do it once. We did it however many times, 7 or whatever, 6 times. And so you don't get the impact of what that's doing for a while. So they're putting themselves in a really difficult place. And then, like you guys were talking about, switching from PCE to CPI. Well, people forget. Retired people, you collect Social Security, that's based CPI. You look at a lot of government jobs, your income goes up on CPI. And so that creates inflation in itself, right? Like everyone's pay is going up by this amount. Another thing that I don't think people understand is when your debt service goes from a coupon of 75 basis points or 50 basis points, whatever the weighted average coupon was on outstanding debt from the Treasury, to 4, you have to increase spending or debt issuance. Like your debt has to go up to cover that, because all else equal, you're paying a lot more interest on what you have outstanding, and you have to make that whole up somehow. You can increase taxes or increase spending, right? Or increase debt issuance, right? There's not many other solutions. So that in itself is also inflationary. So you have all these elements. And I made the comment years ago, I remember it was on a Wall Street desk, I think it was at Credit Suisse, that I kind of feel like high interest rates at times creates more inflation, and it doesn't over time, obviously, you know that, right? But because so many things are tied to these things, you do have money supply that moves around. Now, because of QT, this is a whole nother topic. I don't want to go too much into a tangent, but if you look at M2 and chart it versus, say, interest rates, CT10s, GT10s, that's just generic 10-year note, or the S&P, the correlation's insane, right? Like more money in the market, interest rates actually go down, stock prices go up. You start taking money out of the market, stock prices go down, interest rates go up. It's not rocket science, right? It's supply demand. It's econ 101. And if you have more cash laying around, you buy things, right? You buy stocks, you buy bonds, you buy whatever. And over time, that's why, the money supply component actually has a tremendous impact on things, but the actual interest rate component is different. So I think QT, people always talk about interest rates, right? The QT element, I think, is the most important one. It's obvious. It's usually the most overlooked one. I think if they were to make a policy adjustment soon, I think QT is something they look at, right? Like, why do these banks get into problems? They own longer term bonds versus a lending rate of 0, and the Fed stopped buying them. So who's going to buy them, right? And all of a sudden, these things collapse, and because of FASB rules that they made, I forget what year they did it, but they made these rules essentially. You can put bonds in HTM, and you don't take realized losses. So everyone thinks the bank's capital is better than it is, and now they're in a predicament that if they sell these bonds, they take a capital loss. They become more levered. Optically, they're not that levered, right? But they really are. And so when people take deposits out, that does increase their leverage. So what do? You got to raise capital somehow, or you got to reduce your leverage. Theoretically, I guess you could issue shares, to offset that and then do sales against it. But these unrealized losses haven't been taken care of. I know they have this new program where you can lend the assets against it, which is interesting, but they're using that. You just saw yesterday was the first week in 6 weeks that number increased, and I think that brought a little fear into the markets in that banks aren't as healthy as people think. I'm still in the camp. There's a lot more. It's a 1-year program, right, that they did, and they're not going to let it expire. But there's a lot more, I'd say, bodies, I don't know the politically correct term, to come out of this, right? Like there are unrealized losses that aren't showing up anywhere, and they won't if people stay the pat. But 1 year forward, if you're not able to borrow against it and deposits go down, I mean, we can tangent into this. Bob, do you want me to tangent into my? It's a completely different thing than inflation, but it does matter. I mean, this is all interconnected, right? All these things are driven. People underestimate the impact of interest rates on everything all the time, right? And I think the Fed's underestimating the pace of change. You know what QT did to back in interest rates. I think curve inversion historically has been a predictive of a recession, but why is it not happening now? Well, when the Fed owns 30% of the mortgage market, 20% of the treasury market, you have fictitious markets. Weird. All of a sudden, it's not predicting recession well. Well, you have this uneconomical buyer that owns all these things at a massive loss. Like maybe that predictive nature is not very good. There's a lot of common sense. I think people like using backdated regressions to predict things without looking at changes in the data they're using, right? And I think that creates a lot of mistakes in the way people invest their money and people make decisions.
What else? What are you seeing in the markets right now? The mortgage market this year, this week went through.
Yeah, so there's spreads. I'll try to keep it simple, but essentially, mortgages trade at a spread to rates, right? And there's reasons why that happens. So if your interest rate, say on a 10-year note, is 5%, historically mortgages have traded 70 to 100 basis points higher, aka the current coupon or what investors would buy would trade at 6.75%, something. That metric today is 175. It's pretty unprecedented. The only other times we've hit these levels were during the great financial crisis ever. It's incredibly distressed, and this is as credit's trading pretty tight, right? So you have this weird nuance. There's a lot of reasons why that's happening. Obviously, FDIC just inherited a bunch of bonds, but this started occurring before this all happened. QT being a big reason why. The pace of QT, just like the pace of interest rate increases, really mattered because they also ran off balance sheet 2018, but they did it at a much slower pace, right? And so they're running off balance sheet again at a much faster pace. So that's really widened out mortgage rates. I think the big elephant in the room right now, though, is these FDIC sales. So Signature Bank, Silicon Valley Bank failed recently, right? Everyone knows that. It's all over the news. And since their failure, they've since been acquired or they're working out different deals. FDIC actually inherited these underwater assets because they had such negative equity, right? And so nobody knew what that number was going to be. Everyone thought it was somewhere between, I think it was 80 and 100 billion in bonds that they owned. It turned out to be 114 billion. So everyone hit interest rates immediately because of that. And now they're going to sell them off. They've hired BlackRock as a manager to liquidate these assets because at the end of the day, they do move around, right? If you owned a 30-year bond a year ago, or say the May 2020 issue, if you own that bond, it trades at like $60. So here you are, grandma, doing a good thing, buying a US Treasury, being safe. You buy it at 100, you can only sell it at 60 now. That's down more than it's down more than the stock market, right? Isn't that wild? A 30-year Treasury, you're down more than if you would have just bought the S&P 500 because you're being safe buying your US Treasury. So that's very interesting. Well, they kicked off these sales this Tuesday. And FDIC, if you go to their website, you can look. They have a release on kind of the pace they want to do the sales. They released every QSIP that they're going to sell. And initially, it was a big hit to mortgages, and I can get into that later. But the first sale went off Tuesday, and they sold generic bonds like on the run, like buying Apple. Right? Like it's the most generic of asset you can buy on the run treasury. And these were TBA-like index bonds with the assumption that they were going to get these amazing levels. There was actually a Bloomberg story saying, wow, they went so great, And so they sold 250 million and then they sold another 300 million. So they've sold 550 million this week. The plan is to move that number to 2 billion a week. So they sold 1/4 the size and they want to ramp their way up and they want to not cause stress in the product, which is a product that's incredibly stressed as is. And the most troubling thing, the levels were fine, right? It'd be like buying Apple a penny below the bid side. It was okay. But dealers bought them all, right? This didn't go to end accounts. Like I'm an end account. I could have bought these bonds and I looked at them and these look horrible. Why would I buy these? And it turns out everyone in the world is incentivized for these to go, well, nobody wants mortgages to widen. The taxpayer loses money the more these go down in price. And so everyone was looking at these bonds. And the fact not a single end account wanted them is entirely troubling to me, because this is a sliver. I think they sold 0.3% of what they're going to sell, something like 0.4% what they're going to sell, and not a single end account wanted them. Like, and these stories are coming out about how well this went, and I'm sitting there thinking, like, that didn't go well. And if you look at the Fed releases primary dealer holdings, they're very high. So the street can only do this a few times, right? These eventually will have to go to prices that end accounts will want to buy them, right? End of the day, if Apple price is too high and you have to sell it, you're gonna sell as much as you can, and the price is gonna go to a guy when they think the price is right. And if this happens, mortgage rates continue to go up, interest rates continue to go up. And the problem is, this is what all these banks own. They all own these same assets, right? This isn't like you're going to create more distress, right? And there's not, I don't know if there's maybe the Fed can warehouse these if it starts going bad, like, but then you go back to the old, I was saying the other day to somebody, the only markets I know the Fed saves you or the government saves you. That's it. Anytime something happens, here comes Helicopter Ben, here comes Janet Yellen, here comes, and that's all we've known. And even on CNBC the other day, I think it was Becky Quick was like, so when does the Fed come in? When does the government come save them? And it's like, is it capitalism when you're intervening so much? Like, you look at the good old days, you let a company fail and you give somebody else an opportunity. And we just don't allow that anymore. I wonder why we have these disparities. And I think a lot of it, I think people blame it on policy, but the Fed has probably created a lot of these things too.
There's commentary in the markets that the Fed is now sort of adopting this unspoken mandate to essentially break this cycle of the Fed put, and the idea that they are intent on beating inflation, but behind the scenes in the behind closed door sessions, they say, look, we can't go back to the same old bubble crash. Every time there's a problem, we cut interest rates, crank up the QE engine, and let asset price inflation try to do its magic, because we see where this has gotten us. We've played this game too many times, and it really came back to bite us in the 2020, after the 2021 asset price insanity. And do you agree with that? Do you think that there's that behind the Fed's kind of ignoring some of the signals from CPI and sort of almost lashing themselves to the mast like Ulysses and saying, we're going to be high for a long period of time. We're not going to give ourselves any sort of wiggle room on that, and we're gonna tell you it's higher for longer, and really behind it is this this institutional consensus about breaking this cycle.
I mean, I think any investor would agree it's a good thing to break the cycle, right? You want real markets, right? You want them to work properly and things like that. I guess the question is, even if they want to do that, can they? Like, where would assets be if they've never intervened? They never did QE. They were less aggressive on policy and let the markets work their way out. Now, you can argue we averted a Great Depression, things like that in 2008, but are we too far gone now? Like, can they even do that? What distress levels would they allow? And you got to remember, a lot of people that have recently been put on the Fed are pretty dovish in nature, right? Even though they're acting all hawkish, if employment really starts to break, just look at the political pressure from both sides, right? Can they hold even if they want to, right? And I'd be curious to see a chart of, income disparity and wealth disparity when the Fed intervened, right? I would bet a lot of money that the wealth gap has increased dramatically since the Fed has started poking their nose in and buying things. And I think it's been really negative. And you look at any society, when you start to lose a middle class, it's the death of the society, right? Like, so there are political tensions that are starting to get into play here. And I know it's very important the Fed stays, nonpartisan, things like that. But one, can they? Two, like, how bad does it break if the Fed put's truly gone? they're truly going to get inflation back to 2%, how bad does it get, right? And can they hold? Like, because I heard that Volcker would get death threats. Like, it's wild. I mean, the other thing is the Fed has such a dramatic impact on everyone's daily lives, right? Like more than Congress at times. I mean, money is one of the biggest, indicators of successful relationships. There's a correlation up to a certain point of money and happiness and surveys and things like that. And the Fed controls it, right? So they control a lot of things that we do daily, like, what you pay for your car, your house, all the things you do is tied to that. And these are unelected officials that rotate through, and there's tons of things that go on.
How much of the mortgage market right now is owned by large organizations in the Fed?
So Fed and banks is somewhere around 60%. And it's really interesting. You look at the technicals in the mortgage market, it's like technicals in the stock market. If everyone was long, they had all their money in the stock market, they all became sellers, that would be a really bad thing. Well, when 60% of the mortgage market is owned by two players, that one is letting balance sheet run off, which in fixed income is inherently selling, right? Because fixed income, you reinvest a coupon, principal, whatever it is. So the Fed is essentially selling, and banks probably, already they're sellers with SVB and Signature, but there was regulation today in a headline that they're going to start focusing on smaller banks, but also probably Jamie Dimon actually referenced this the other day. Deposit durations forever were soon to be 7 years. Well, a current coupon mortgage has a 7-year duration. It's partly due to the AM schedule, partly due to the prepayment nature, because you can prepay your mortgage, aka you can refinance your mortgage if rates go lower. So that duration kicks out to around 7 years. So mortgages were the ideal thing for a bank to buy. And so they became the biggest owners of mortgages, right? So you have the two biggest buyers in this market, who one is selling actively, the other one is actually selling actively because of FDIC, and they'll probably get regulated to sell even more. Well, you're not going to see the rest of the market be able to pick that up, right? Like, where does that go? Like, who's the buyer? In fact, no end account wanted the first 550. What about the other 113.5 billion they have to sell? Like, it's very troubling. And if that market breaks, all mortgage rates are tied to this. So all of a sudden now you're breaking the housing market. Well, we saw every time the housing market breaks, what happens? You have a financial crisis, you have a depression, it's bad, right? Like, that's the majority of most people's net worth, right? Like, I think only 50 or 60% of people even own equities. I think it's 66% on a home. So, it's not good longer term. I don't want to sound all bared up, but it's hard not to be. I do think the Fed will come in and intervene when they have to. I think it's just too political. If things start getting bad, they're just going to go back to buying and lowering rates. And does that mean like deglobalization? Is inflation, like BlackRock's in the camp? There's a bunch of other large institutions that are pointing to things that led to this ultra low inflation rate for so long, uncoupling, right? Like, if we're moving, and maybe we're moving to India, like Apple's already moving to India. So maybe there's different globalization, different channels that fill that in. But, if things become less efficient, maybe you have higher stickier inflation. It's unclear. And as long as that goes into wage inflation, things should be okay. It's just something you deal with.
Well, the yield curve has been on a wild ride, and that's essentially what you study, right?
Did you see yesterday was super interesting, the 3-month bill auction, or sorry, the 1-month bill auction versus the 2-month bill auction.
That's what I was
Those
are
pretty parallel. Or if the Fed's predicted to raise 25 basis points, there'll be some time value weighted in money. It's formulaic, and they might be a couple basis points one way or the other, whatever, not a big deal. The 1-month traded at 319, well below money markets and things like that. And the 2-month traded at 485. It's the largest gap ever. So what are the markets telling us? The markets are saying this debt ceiling is no joke. Like, we might default. Like, we've never had this happen. Even when we had this, like, what was it, 2011, there was some technicality, but we actually ended up paying. Everything was good. Wasn't deemed a default. But the bill market's saying there's a real probability that this doesn't work out. Already they're not even talking, you just hear comments, and the rhetoric politically has gotten to such a point. I don't want to get politics necessarily, but it's gotten to such a point that we could make the dumbest decision ever and default on what everything is priced to just to prove a point and be partisan, which is silly to me.
There was a default. What was that, 07? The government did default for a brief period of time. It was about, I think it was
They
several
didn't
hours.
deem it a default though, didn't they? I don't think they
you're
deemed
right.
it.
I think
Yeah.
you're right.
ISDA or whatever said it wasn't actually a default. And they're the ones that determine that on CDS, things like that. So
Yeah, that's the kind of magical question, right? Like, what is a default? How do you define it in particular? And you know, and that's
AT1
where some
bonds.
of these things like, you know, the full faith and credit clause, like if the White House says, hey, full faith and credit clause, we think it's unconstitutional for this to happen, we're just going to keep making payments. Hey, Supreme Court, you know, what do you think? And you know, what does ISDA do then, right? I mean, that's not a great look for the markets, obviously, but we also saw this dynamic. Do you expect a replay of kind of what we saw with, obviously it's not as severe, but the downgrade in 2011? What happened? Well, there was a flight to quality. What was that quality? Well, treasuries rallied and the dollar rallied, which
It's
is, you know,
wild,
which is
right?
paradoxical in some ways. But if the worst case scenario happens, or there's, you know, and or the White House is forced to invoke one of these very novel kind of countermeasures, what do you think? Do you think that there's still that flight to quality that actually has people buying treasuries and the dollar again?
Yeah, I mean, I think that's still the default. We're still the reserve currency, right? And if we lose reserve status, I think that's if the US defaults and there's some question on the reserve, which you could argue that the reserve status is going away anyways. If you look at purchasing power parity of the US dollar versus every currency but the Swiss franc, we're essentially the richest, right? AKA, we have the most purchasing power parity of our dollar uneconomically versus every other country. So we trade rich because we're the reserve, because the Swiss system where everything goes. And I know that the Saudis and the Russians and the Chinese are trying to get around that with their own system, their own SWIFT to move out of US dollars, but it's still something like 90% of all commodities transaction globally go through this, go through the dollar, right? And so naturally you want dollars, you want what everything transaction. And it's, I think people buy dollars and they buy treasuries because you need to transact, you need to buy your oil, but you lose the reserve, they're just going to go buy whatever the reserve is, right? Because that's what gets you what you want. If you need oil, you need food, and you have to go and transact, and everything goes through this reserve currency. That's why people buy that, right? They're buying it because they want access to something they can trade for what they need, whether it's food or whatever it is. You start to see the reserve, and we've been the reserve since what, Bretton Woods or whatever, and probably like since World War II, really. Like everything's kind of been dollar, right, since then. And so the world we know, we've been subsidized. Our goods have been subsidized by other countries. You know, already if you look at just China, which is one of our biggest suppliers of everything, as their labor costs go up, we're looking at other places. You see all these shirts made in Thailand, things like that. Like eventually you run out of places to do that, I imagine. But I think the flight to quality bit is driven entirely by that, right? Why would you buy something that's defaulting? Well, you can use it. Can't use other things, right? I do think the bill auction is telling us a lot more, and it was a very I mean, there were a couple articles, but it was really under the radar. And it's funny, like you look at hindsight of all these instances of housing and, you know, the bad bonds they were making in 08. Like people know about it, but they sort of ignore it when things are frothy and, you know, you're happy and fat and you got your Hamptons house, whatever else you got going on. It's easy just to ignore these things. And I worked on the street. I mean, you get so siloed in everything that you're doing that you don't do the work. I was a market maker, right? I traded 30-year flow and I ran a securitized group, and you don't have to do the second level work, and investors are doing that, hedge funds are doing that. But the people everyone listened to in general, like if you're Renaissance, you're not telling people your secret sauce. You know this big trade's coming. These guys are smart, right? And people talk their book, like the famous things when, I don't know if I should reference the name. There's a famous investor, whenever he got on CNBC, you knew he was doing the opposite, right? And it would show up 6 months later, he's doing the opposite. Because why would he tell you what he's going to do if he didn't already own them, right? Because the asset would get richer, and then he'd have to go buy something richer. That's silly, right? And so you essentially hear from these people that aren't really investing. And it seems like everyone wants to be a movie star now, right? Like the Fed wants to be a movie star. Look at them on TV. They're saying just these crazy things because they get interviews and they get press and they're on TV and, oh, I'm famous. And same with Wall Street strategists, same thing's happening. And it's funny when they come visit us. I like to ask questions I don't think they're going to know, because I'm going to take their research a lot less seriously if they don't know. And it's very easy when things are good to not do the work. And I think, or to ignore things that are pointing out because it doesn't serve your purpose. And at the end of the day, the street makes its money off underwriting fees, and you don't want to. It's the famous saying they say where, how many sell ratings do you see on stocks versus them going down? Like they're going to lose their business to put a sell. Like, oh, the stock sucks, so we don't want to use you anymore to issue debt. Then okay, like they're not incentivized to ever be that negative, right? So, and that's who people listen to. My dad, when he gets on his Merrill Edge or whatever he uses, he looks at the research reports. Just, those are the guys they trust.
Caleb, are there any investment implications for learning that surveys, massively adjusted and scant survey work is representing a gigantic portion of the CPI?
Yeah, I mean, just the imputation alone, given 38%, 37.3% of that survey is fictitious. They imputate it, aka they have a formulaic way of just filling in the blanks. On top of that, it's incredibly biased. Bob, what's your house worth? You're going to say as high as or what could you rent it for? How about that? You've owned your house for 20 years, and I go, what could you rent your house for? I don't know. I get on Zillow and I look at rents around.
I wonder how many people know anything about doing the work on knowing what their house would be able to be rented.
Yeah, and especially
and there's no connection to reality because nobody's actually renting their houses afterwards to prove out that the number was right or wrong.
And the other thing is, not only that, but there's just so many other nuances that go into that question on top of it. And I think the media matters more than ever, right? When you're seeing stories about rents going up, rents going down. If every story is rents are going down, you're probably going to haircut it, right? And that's
especially if momentum is the determining factor for the largest determining factor for where that portion of the CPI is heading anyway.
Well, the funny thing about CPI too, when you're looking at that data, and CPI is incredibly complicated. I've tried to go down that rabbit hole, and everything is formaic and adjusted, and regions they use. And so it's funny, every other survey they use 3 metropolitans and then they do everyone else, which I thought was interesting. So like, what if those metropolitans are doing better or worse? Like, you know what I'm saying? And it's the same 3, which is interesting. And I also feel like changing something like that when your Social Security, which is one of the biggest liabilities we have as a government, is tied to that. Like they're probably incentivized to lower CPI in general, right? Because we pay a bill on it, right? I don't know, and which political sides involved probably matters on what you want the data to see. And it's interesting. I will say they do a lot of work. Like they do a million research papers. I think it was in the 90s. They Congress banded together and made a committee to investigate why CPI was what it was. And I'm kind of shocked that's not being spoken about now. Like just knowing that house prices are going down, the biggest component of CPI increase has been housing. Like, I don't know, it just seems inaccurate, especially when 66% of people own homes right now. Like the home ownership rate is pretty high. And we're not even accounting for that because they deem it an investment, not a continual usage. But
I guess also it's not obvious that this is the wrong way to do it, is it?
No, I mean,
that portion of CPI doesn't move very much in any individual's life anyway.
Yeah.
So that's the intellectual exercise about this whole thing is also very interesting because it's hard to come up with a better way of doing it.
I mean, I guess there could be like, is there a way to do something where you basically get your expenditures on the year, right? And just do a massive data collection. I'm sure banks could do that, right? Just there's got to be a way to do it in a better way. Like just in terms of you have money in, money out. That's your life. That's a business.
Of course, Case Shiller is faced with the same thing. Just measuring whether which houses trade every year. It's also
Yeah, Case Shiller has flaws. I think Case Shiller actually throws out data points. Don't quote me on that. I think I recall that. But if you're a company like Zillow and you have real transactions, that's going to be pretty good. If you're like realtor.com, like we have data aggregators that are pretty good now, right? Like, and they have a lot of data. Like you think about, why do they pick 32,000 homes? Well, that should be a 95% confidence interval roughly, with plus or minus 2%, right? Roughly, that's kind of the math behind it. There's 125 million households. You can plug that into your little statistics calculator, and it comes up to that. That's what statistics say. Oh, we want a 95% confidence interval with this much plus or minus, and that's it. That's where that number came from, I'm sure, right? And they adjust it. They adjust it all the time too. I mean, you think about the percent of shelter going up 2%. As all of CPI, I mean, they are doing their best, I think, with what they have. But I don't know if anybody has ever like done a coding language or anything like that, or even your house. We'll do a simpler example. Your house, you have something broken, you patch it, you patch it, you patch it. Well, the CPI has been around forever, and this owner's equivalent rent came around, and I think it's 1983, and they've made a ton of changes. They're just patching something, right? They're not changing it. Because the last thing they want to do is when you have all these retirees and you're changing their payments, all of a sudden changing CPI to plus 10%, minus 10% because of a data issue, because you changed the way you calculate it. And so that's also getting trickier. And remember, 20 years ago, people on Social Security is much smaller than today. And tomorrow it's becoming a bigger and bigger liability. So the implications of this number becomes more dramatic, right? I mean, you think about government spending as a percent, and a lot of government jobs, the salaries are tied to CPI. CPI is very significant for a lot of things. And CPI is momentum in itself. Like they always talk about how, you don't want this ingrained inflation. Well, it's going to be, right? Because pay is tied to it. All these other programs are tied to it. So it inherently will become momentum based, because as it goes, unless you have a crash, they'll let offset that as a crash, right? So
yeah. Well, Caleb, thank you very much. That was
thanks for having me on.
Very interesting discovery, and we'll have to figure out how the Fed's going to respond to all this.
I know we went on a bunch of tangents, but I appreciate you guys having me on. So
our pleasure. It was great exercise in increasing knowledge.
Yes. And the Fed's got a tough job, but that doesn't mean they won't foul it up.
Yeah, it's we're all rooting for them, right? To get this thing under control. So hopefully they figure it out. So awesome. I pointed out a lot of bad things, but seems like things are going the right way.
Great. Caleb, thank you very much. Have a great weekend.
You as well.
See you, John.